History has shown that when inflation gets over 7%, which it did in many developed countries over the last couple of years, it has historically taken somewhere between 4 and 16 years for it to get back under 3% again. So inflation tends to be what's known as quite sticky. Once it comes out of the bottle, it's quite hard to put back in. Hi, this is Chris from StockSpot, and in this video, I'm going to be diving into a pretty timely and topical area at the moment, which is what are the best performing asset classes in periods of higher inflation historically. Now, in times of economic uncertainty, understanding this relationship, I think, between asset prices and inflation is pretty essential. Now, if you look back a few years, in March 2020, during the height of the COVID-19 pandemic, the global economy faced really unprecedented challenges. And to counter those issues, governments and central banks basically went on a big money spending and money printing spree. And these policies led to a bout of pretty high inflation a year or two later in 2021, 2022. And while today, now looking in 2023, inflation has started to come back down, history has shown that when inflation gets over 7%, which it did in many developed countries over the last couple of years, it has historically taken somewhere between 4 and 16 years for it to get back under 3% again. So inflation tends to be what's known as quite sticky. Once it comes out of the bottle, it's quite hard to put back in. And in a study by Cambridge Associates, which I think has done some great research on this, they looked into what asset classes historically have done well in these periods of rising and higher inflation. And they found a few things. So the two best performing asset classes historically in those periods of time have been commodities and gold. They've been the two that have best performed in periods of rising inflation. And they found that a 1% increase in the inflation rate over a year estimates to increase the price of gold by about 9.4%. So it's obviously very sensitive. But then gold and commodities were closely followed by resource shares, obviously are influenced by commodities quite a lot, and inflation-linked bonds as two of the better performing asset classes in historical periods of higher inflation. On the other hand, assets that have done less well in these periods have been traditional bonds and also shares, and particularly shares in US companies. But here's the catch. Assets that are highly sensitive to inflation, like gold and commodities, haven't actually delivered very strong long-term returns across the whole cycle. And so it's important to still be diversified and have some other asset classes in your portfolio, even during periods of high inflation, in order to capture the long-term returns of markets and not be overexposed to inflation-sensitive assets. So that balance is really important if you're investing in order to achieve great long-term returns across the cycle.